Fantastic. Well, thank you, Tanya. It's always a pleasure to be involved with these webinars, and I do apologize for the slight late start. No webinar, as Tanya very well knows, is complete without a last-minute technical hitch. And I would like to warn you, I'm on my laptop today, so forgive the background noise. Unfortunately, my computer crashed at the last moment. So here we go. This section is dedicated to teaching you how to trade the news like a professional. My name is Rob Colville. I'm head of the online brand, thelazytrader.com. And for those of you who don't know me, I've been around the block quite a few times, actually. I started trading back in 2007 and was actually the worst trader known to man or woman. And I made every single mistake in the book several times around, and a few more times just to make sure. And I went long when I should have gone short. I went short when I should have gone long. I mistook currencies for commodities, you name it, I made that mistake. But after months of arrogantly thinking I could really try and corner the markets by myself, I eventually stumbled across a end of day style of trading, which enabled me to really slow down my trading. And as I discovered, there is a disproportionate relationship between what you make in the market and the time spent in front of the screen. So as I was losing back in those days, I basically figured that, hey, if I'm unprofitable, which I was, I figured that at least trading the daily time frame or the weekly time frame would mean that my losses would be at least a slower process. But sure enough, over time and trying lots of different strategies, I devised my strategy, or a selection of them actually, which have worked ever since. And ever since becoming consistently profitable back in 2009, 2010, I founded the Lazy Trader brand, initially as a blog, really, to kind of like help other people in the same situation as me back in the day. And it's metamorphosed really into an online trading brand. And for those of you who don't know me, I used to be a journalist, and I still keep that going. I write for a myriad of publications, and I contributed to names like World Finance, FX Street, FX Trader Magazine, you name it. And the great thing about end of day trading or end of week trading is that the strategies, certainly which I'm going to talk to you about, are universal. You can essentially apply them to currencies, stocks, commodities, and it frees up a lot of time. They say that beyond money, time is the most precious thing you have because it's one thing that money can't buy. And this is what I really kind of like cannot emphasize enough of end of day trading. You can make as much money potentially as if you're intraday trading, because there is no relationship between time spent in front of the screen and the money made, or indeed the number of trades you take. So this style of trading has enabled me to basically live a lifestyle which entails some of the more fun things in life, like traveling, tennis, photography. I also like to give back, so I mentor disadvantaged young entrepreneurs on behalf of the Prince's Trust, which is run by Prince Charles here in London, the UK. And that's enough about me. I can witter on all day about myself, but I'm pretty sure you didn't take time out of your busy day to listen to that. So let's crack on. I just want to assure you that you're in safe hands. We've got a great, there are a lot of scam artists out there, a lot of pretend Forex educators or trader educators, and obviously, you don't have to believe a single word of what I say. By all means, do your due diligence. But certainly, we've got a very good reputation on independent third-party review sites like Forex Peace Army. We've got good reviews on Facebook, Trustpilot, if you have it around the world. We have it in the UK. We've been Facebook reviews. We've also been accredited by the Society of Technical Analysts, and our courses to boot have just been accredited by the CPD Standards Office here in England. So, like I said, do your due diligence, but you can take it from me, you're in safe hands. So just have a look at the risk disclaimer and warning. There's nothing untowards there, pretty standard stuff. So today, let's get straight to the pith of this. We're going to talk about how news affects the market, the currencies we're going to have a focus on. I'm going to bulldoze some of these previously held misconceptions that a lot of people entertain. I'm going to talk to you about the components to successful news trading and how you can essentially go towards it with a clear head and not have to worry about the outcome of the trade. And risk management, we're going to go through that and a couple of examples. And hopefully by the end of this, you will really fall in love with a style of trading which is low maintenance. You can set up and walk away and feel very relaxed about it. Okay, so that is what lazy trading is all about, and I hope you benefit from this webinar. Okay, so first things first, How news affects the market? Well, of course, as many of you may or may not be aware, currencies in particular are very susceptible to intraday news announcements from any country really pegged to that currency. For example, in the United Kingdom, if we have something, an enormous release or referendum, shall I say, like Brexit, and in the eyes of uncertainty, it means that something adverse or unpredictable, the markets aren't going to like very much. So lo and behold, we saw the British pound decline rather rapidly against the US dollar. But that was an extreme example. Slightly more kind of like day-to-day examples are, for example, retail sales releases. Essentially, the better the release, the better it is for the country the release is from. So if it's better than expected, then you can see that country's currency appreciate against the one it is paired against. Okay, so the movement of any currency is essentially reflected by the gap between what is expected by the market, what is forecasted, and what the actual number or release is. If there's a big disparity, then you can reasonably expect a huge move. Okay, so in a nutshell, if the news is good, then that's going to benefit that country. So people buy into the currency because it's a sign of confidence. If the news is bad, then the currency or asset class, shall I say, will go down. We use news. We don't actually trade news directly, but what we do is we simply use news as a catalyst to help drive our trades. If we're the right side of the market, that is. Of course, there's absolutely no guarantee we might be on the right side of the market, but we use news to essentially drive our winning trades to make even more money. And if, for example, our technical setup ends up being a losing trade, then at least it gets us out of the trade quicker. Okay, so it's really a kind of win-win in this sense. So just to really reiterate, typical news announcements could be, well, the big ones are essentially the biggest number, certainly released on a monthly basis as non-farm payrolls, but of course you get smaller ones like, for example, you get inflation reports, anything to do with interest rates. You might get the ECB, the Bank of England, or indeed the Federal Reserve speculating and posturing over whether they're going to make a rise or an increase in interest rates. And if that happens, generally speaking, that currency will go up because it's a sign that they want to cool down the economy, for example. And if the interest rate goes up, then typically money will be attracted to that currency because investors will be getting a much better return from holding that currency than the one it might be paired against. Okay, so there are a lot of misconceptions when it comes to news, and I want to go through them all with you because a lot of people come to me and expect this kind of enormous segment on news trading with lots of complexity, lots of number crunching, but it really isn't that difficult at all. Okay, so number one, do you have to be exceptionally smart, an MBA holder, an accountant, or rocket scientist to trade news profitably? Well, the good news is a resounding no. Okay, so rest assured, put those we'll keep the calculators in sight, but don't worry about enrolling onto like a Harvard program in kind of astrophysics or anything like that, or rocket science, because it really, you don't need that at all. Okay, so are people who are able to get it right all the time? Well, no one gets it right all the time. I really like to emphasize this. A lot of people lost a lot of money anticipating that Brexit wasn't going to happen. Some of the big players in the market, like Barclays Bank, they got it very wrong indeed with that. So that's just one isolated example, by the way. Of course, we all know a very famous example of Nick Leeson and Barings Bank back in 1997, where he was betting on the Nikkei going up and up and up, and of course the Kobe earthquake occurred in 1995, and that really kind of went against his trade, and he ended up bankrupting the Queen's Bank, Barings Bank. That was the end of an institution. So essentially nobody gets it right the whole time. Some people get it right a lot of the time, but nobody gets it right the whole time. There's no Nostradamus in the market. And bearing that in mind, we can really use news to manipulate the outcome in terms of making a good return. If it happens to go away, and if it goes against us, obviously we have absolutely no control over the market and what direction it will go in. But if it goes in our favor, we can target trades of high profit probability and use news if it goes against us to simply get us out of a losing trade. Okay, another one. Okay, do we need to tune into CNN, Bloomberg, or the BBC, or have a live news feed in order to profit from the news? Absolutely not. Just save your money And no need to get square eyes ogling all over these leading luminaries on CNN. I mean, if you tune in to that program or Bloomberg in the morning, you'll have some pundit talking up the US dollar in the morning. In the afternoon, you'll have a pundit talking it down. In the evening, everyone's confused and they just want to go home to bed. And lots of advertisements follow. Okay, so is there a holy grail when it comes to news trading? No, I think those of you who've been around the block a bit like I have, you've probably come to the reluctant conclusion that in trading in general, there's no holy grail. Shame that. I tried to find it and it was a very bumpy ride. And guess what? I still haven't found the holy grail, but I've certainly found an edge and I'm going to share that with you right now. In fact, I'm doing it right now. So is it really possible to make a decent return trading the news? Absolutely. And that's exactly what it's all about. Okay, so hold on to your hats. We're going to show you, but I just want to show you the ingredients. Just like in the kitchen, in a cordon bleu restaurant, you will find that in order to make a decent dish, you'll need the right ingredients and know what to do and when to do it. It's like that with news trading. Okay, so first things first, let's talk about a profitable strategy, and we've got a number of them. A stable time frame with a daily and the weekly time frame. The good news is they're pretty resilient news actually, because the distance between our entry and our stop loss is generally quite far. Positive reward to risk, this is a big one. Okay, so we only trade setups which has a minimum of a 2-to-1. So if we are looking to essentially place the trade and say risk $100 or $1,000, we want within the realms of possibility to potentially make a return of twice that. So $2,000 return or $200 return. So we want to make at least twice what we risk. Of course, there's no guarantee as to whether we really do or not. We just let the markets do its thing. Risk management, risking 1 or 2%. We risk absolutely no more than 2.5%. Generally, we risk 2%. But if you start risking more, then things can go off piste very quickly. Okay, so we want to be, before you're profitable consistently in trading, it's all about survival, and break even is a much underrated place to be. A lot of people see it as something they don't want to admit to, but any of my clients who come to me and they say they're at break even after a year's trading, I give them a hearty pat on the back and say, congratulations, that's a great place to be. Use a stop loss. Well, you wouldn't go bungee jumping without a cord. It's like with trading and going into the markets. Would you really want to basically risk your entire account based on one movement? Rest assured, if you decide to bet, say, on the British pound going up against the US dollar, not that we've had that opportunity for a long time, by the way, but if you decided to do that and the market goes against you and you haven't got this stop loss, which is order, which gets you out of the trade, if it goes against you, then it's very likely that your account will be wiped out. Okay, and the last thing, which is probably the best thing to have, is the ability to sit back, forget, and relax. And this is where having a dog or a cat comes in handy, because you can indulge in quite a bit of dog walking and let your trades just do its thing without you meddling and abusing your trade. There's nothing worse than watching your trade when it's in motion. It will send you on an emotional roller coaster, and you do not want that. You want trading to be a peaceful and relaxing hobby, not a stomach churning, pulse pounding foray. Okay, so profitable strategy, we want a proven strategy to suit your personality. This is something or a stage in which you will determine yourself. We trade bounces and reversals. We do not trade breakouts. A simple reason for not trading breakouts is the profit potential is typically less. I far rather get a tighter entry after a breakout trading a bounce than the actual breakout itself. Positive reward to risk, like I mentioned, and simplicity. The simpler the strategy, the better. A lot of people think when they're new to trading that they have to have all sorts of widgets and cogs and screens and indicators. Actually, I would like to really assure you that none of this is necessary at all in order to do well from trading ultimately. So trading on the higher order timeframes means that we are less likely to get stopped out, like I mentioned. We can benefit from much bigger moves and essentially not worry about being picked out by intraday volatility. If your entry is closer to your stop loss, you're more likely to get pinged out earlier. Okay, so we only trade, like I mentioned, when we are able to make more than what we've risked. That is a valid business decision. When you've got reward to risk figured out, you'll start looking at many decisions in life outside of trading in terms of reward to risk. What am I getting in return for this decision? It's quite a nice position to be in, and I recommend it. Risk management, keeping the risk low. There's absolutely no guarantee that any trade will have a desired outcome. So even if it's the best looking trade, the pink cow, if you like, if you forgive the analogy, If it looks like it's going to make you a lot of money and be a dead cert, then you might be disappointed. Okay, so no matter how good the trades look, keep your risk to a minimum. And this is one of the key cornerstones to long-term survival in the market, as well as using a stop loss. Okay, so trading, a lot of people, when they arrive at the market, think that in order to be good at trading, they need to be in front of the screen all day, they need to place numerous trades and be engaged with the market, read the Financial Times, be plugged into Bloomberg, have numerous screens, and really be kind of like in this state of ongoing consciousness. Well, the good news is none of that really is necessary. All you need really is a laptop, which is exactly what I'm presenting off now, a charting package, an internet connection. You don't need news, you don't need Bloomberg, you don't need any live feeds, and you really just need a few principles like what we've mentioned and the ability just to be patient and disciplined. Okay, so risk management, let's go into this in a little bit more detail. I understand that there is a mixture of abilities watching today, so I want to get everything covered, and I never like to assume that you all know this. So the key tenet of trading news is keeping the risk low. So just substitute the pound signs for dollar signs if you're not familiar with it. I know we've got a big contingent from America today and Canada, so welcome. So say, for example, we're risking £1,000 or $1,000. We risk no more than £10 or $10. And no matter how big or how small our trading account is, even if it's a tiny account, like $1,000 or £1,000, this principle is absolutely key because it keeps us in the game for far longer. If we're trading with £100,000 or dollars, we risk £1,000 or $1,000. Okay, so in order to work out how much we are trading per point or per pip, we divide 1% of our trading account with our entry price, take away our stop loss. So that will arrive us at our stake size, how much we're risking per pip. Excuse me. Okay, so say, for example, we have £10,000, or let's just say dollars, for the sake of the fact that a lot of people are from the other side of the pond. We use 1% of that, which is $100, and that equals $100 risk. So we divide that. Say, for example, we've got a difference between our entry price and our stop loss of 50 pips. We divide that £100 or dollars, or that 1% of our trading account, by 50 to give us a stake size of £2 per pip. Okay. Risk reward or reward to risk, whatever you refer to it as, we always go for a 2 to 1. Okay, so we're risking, say, £100. We want to only be trading setups which could reasonably give us twice of what we risked. Okay, so why don't we really care about the news? Okay, a lot of people ask me why specifically. Well, the fact of the matter is we actually have no control of the news whatsoever, and the timeframes we trade are generally immune to news announcements, intraday spikes, and things like that. So we look at chart patterns, and being technical traders, we gauge the probabilities and possibilities by looking at the story the chart is telling us based on our wider understanding of the market. Okay, so we trade happy in the knowledge to leave our trade running regardless of the news. Okay, any of you who've done any back testing and you've been testing any strategies independently, I can bet your bottom dollar that you would not have factored news into the equation when doing the back testing. And if a strategy is profitable when you're back testing, then that's great. I mean, it's irrespective of news announcements on what happened on what day and when and who said what and anything like that. Okay, so we're not fundamentalists. Sure, at the Lazy Trader, we do look at the fundamentals, and that is for a different seminar, but it's only 20% of our trading. Okay, most of the time we don't really care. Do we care what Yellen or Bernanke even are saying at the Federal Reserve? Not really, actually. In fact, I couldn't really care less. And same with the ECB and the Bank of England. Okay, and this leads me on to saying we have no access to inside government circles or lawmakers or anyone with privileged information. It's a level playing field, and we trade the chart according to what the chart specifically is telling us. Okay, and we rest assured that some people get it right some of the time, but nobody gets it right the whole time. Okay, so we look for probabilities, and if the reward to risk really adds up, okay, based on our setup, then we'll take the trade knowing that, hey, there's a 50-50 chance that the news is either going to be in our favor or not. If we've got a 2 to 1 profit potential, if we're risking the news and the 50-50 chances is in our favor, then we've made 2%. But if 50-50, the news doesn't happen to be in our favor, then we've lost 1%. And that's just one example, okay? So high reward will generally always carry us. So like I said, it's like flipping a coin, heads or tails. Okay, news can either be in our favor or not, depending on whether we're long or short. Sure enough, if we're in a trade setup with high profit potential and the news helps to be a catalyst and in agreement with our trade, then fantastic. There's a 50-50 chance of that happening. But if it is against or in disagreement with our trade, then at least the risk is small, 1%. All right, so it's very similar to flipping a coin, heads or tails, knowing that if it lands on heads, you can make, say, $300, and if you're landing on tails, then you lose 100. Okay, so it's exactly the same principle. So a lot of people, when they look for potential reward on the charts, there's a bit of a disparity between what the market is likely to deliver them versus what is possible within the realms of possibility. And a lot of people sometimes kind of fantasize over like what they want to make versus what is possible, and that's never very good when that happens. So we do need to be very kind of like logical with that and go with what is likely versus what we want to happen. Okay, remember, the higher the reward, the lower the probability in attaining that reward. Okay, so in terms of finding profit potential, what we do to find our reward to risk is simply get our entry price, take away our target price, and divide it by our entry price minus our stop price, and that will come to a number. Okay, so I'm going to show this on the chart. So say, for example, we had Euro GBP, we had what we call a bearish pin bar reversal. At the top of the range here, as you can see, it looks more like a head and shoulders, with the left-hand shoulder, the head, and the right-hand shoulder. So we placed our entry just below the low of this bearish pin bar reversal, stop loss above the high. We knew that, hey, the difference between our entry and our stop loss is 67 pips. But our ultimate profit at the bottom of this range here is 246 pips. Well, that's a very good profit potential. That's a 3.6 to 1. So if we have a $10,000 trading account and we're risking 1% on this trade, if, for example, we are right and whatever news announcements happen between us getting into the trade and our verdict, if they happen to agree with our trade, then we know full well that we have potentially a 3.6 to 1 or $360 to make from this, versus 1% of our trading account potentially lost if we're completely wrong and news does go against us completely. Okay, so if you recall back to what I was saying about the flipping of the coin, you've got a very kind of like lucid example here. We've got another one here as well. This is the British pound versus the Australian dollar. We had an upward trend, and we had a bullish pin bar reversal, which is one of our buy signals to go long. Funnily enough, actually, this closed on the eve of the general election in 2015, where the Tory party, the Conservatives, were neck and neck with New Labour in the elections. And of course, we knew full well that if the Conservatives won, the markets would rally. After all, they're a lot more business friendly, whereas if Labour won, the British pound would probably fall quite drastically, as well as the FTSE. We had no idea who was going to win. It was 50-50 at the opinion polls and certainly the exit polls after the election. But this bullish pin bar reversal wasn't an election day. We knew that if the Tories won, it would go up. If the Tories lost, it would go down. So given this 50-50 potential outcome of the elections, we knew that, hey, if we're right, we've got 838 pips to potentially make versus 186 pips potentially lost if we are wrong. But please don't forget the fact that we've got 1% only risk on this. So if, for example, which 838 divided by 186 is a 4.5 to 1 reward to risk. So say, for example, we had a $10,000 trading account and we risked 1%, which is $100, and we were right, 50-50, by the way, like I said, between the Tories winning or losing, then we'd make $450, and if we were wrong, we'd lose 100. Okay, so you can see how we're using news really as a catalyst here. So if we're right, we are able to piggyback a move in the favor of our trading direction. But if we're wrong, we can keep the risk to a minimum. Okay, So this is a couple of examples here. For example, we've got Brexit here. Well, I say Brexit, this was the prelude to Brexit. We had a bearish pin bar reversal at a multi-year high, representing a lower high and a potential double top formation. This was pound Swiss on the daily time frame, and we traded this one as with our entry just below the low, stop loss above the high as a potential reversal. Okay, and we had a huge range to potentially take advantage of. This was in December 2015, so a long time ago, but it doesn't matter. I mean, if we had it tomorrow, we would trade it. Okay, so entry was just below the low, stop loss was above the high, and we had all this profit potential, and that's just that's just to our first target, sorry. We had numerous targets within this range here. So we risked 1%, and that's 76 pips, to potentially make 18%. 1,404 pips, and that was just to our first target. Some of our clients with this move alone on target 3 or 4 doubled their trading accounts because we were able to add to the position later on, which is a slightly more advanced thing. But basically, had we risked $100 on this trade, say for example we had a $10,000 trading account and we risked $100, then we would have made $1,800. And had we lost, we would have only lost $100. Okay, so you can see that the reward to risk really made it worth our while, and we would have traded this one irrespective of Brexit. Okay, so this is what actually happened. You see, remember that bearish pin bar reversal just here? Well, it went all the way down here, it hit target here, 18%, and then smashed through this horizontal level. We took profit here, we added the position here, we added the position here, we added the position here, and it went all the way down again. And this is this is actually even before Brexit. So Brexit happened a little bit further on in June. It's not even on the charts yet, but you can see that whether Brexit was in our favor or in favor of the trade, then it would have helped to exacerbate our wins or kind of perpetuate our wins. But if everyone voted for Remain or the Remain camp won, then it would have essentially, we would have been able to have taken profit along the way, but it would have hindered our winnings slightly. But we have no way of knowing in advance, that's the thing. Okay, so another example is the UK general election, like I mentioned just now, with the British pound versus the Australian dollar. We had no idea who was going to win. The Tories, the Conservative Party, or indeed New Labour. It's a two-horse race between Ed Miliband and David Cameron. We knew that if the Tories won, the market would rally or pound would strengthen against the Australian dollar. And if New Labour had won, then it's likely that the British pound would fall quite heavily against the Australian dollar. It was 50-50. So we saw a technical setup here to buy in an upward trend. This was a false breakout of this kind of congestion zone here. We look on a slightly higher time frame, we can see that it's an upward trend. So our entry was just at the height of this bullish pin bar reversal. Stop loss was below the low. And we knew full well that we'd make, if we were right and the Tories won, remember it's 50-50 between them winning or losing, we would make 4.9 or 5%, let's just say, risking 1%. And if we were wrong, we would only lose 1%. Okay, so it is like flipping that coin, knowing that if you happen to be right 50-50, then you're rewarded handsomely for it. And if you're wrong, you don't really lose that much at all. You lose 1% of your trading account. Okay. So there you have it. That's the UK general election results. Some of our clients exited all the way up to the very top and beyond. And this was a while back, but of course Brexit's happened since then and forced the British pound down against the Australian dollar, as it has with the US dollar and pretty much every other currency pair out there. Okay, so coming to Britain on holiday is cheap these days, so don't worry. It's not that expensive. I think it's Norway, which is the expensive country, most expensive country in Europe to visit. Okay, so the Scottish referendum. Now let's move on. We had that one as well in 2014. Please bear in mind these are just random news, like enormous kind of news events, which we traded, but we didn't trade at the same time. We happened to be in the market, we happened to take the trade setup, but we just simply had these events acting as a big catalyst to either helping to determine a hugely profitable outcome or a quick loss. Okay, so remember, we don't actually directly trade news, we use news as a catalyst to determining either a very profitable potential outcome or just a quick loss. And the great thing is thanks to risk management and our stop loss, we can curtail the extent to which the loss is. So keep it to 1%. Worst case scenario, if there's slippage against us, then we can, it might be a bit more, but generally speaking, if the news does force the trade or help the trade continue in our given direction, in the direction of profitability, then that's a wonderful thing. Okay, so the Scottish referendum, which we had on the 14th, well, again, it was a bit of a divide going on between people who wanted to, the Scots who wanted to remain a part of the Union and those that wanted to break away from the 300-year Union, which they had the United Kingdom. And we saw this sell trade on the FTSE, bearish pin bar reversal, the top of a well-established range. We looked at that and figured that it was more likely that the FTSE is ultimately, from a sheer supply and demand standpoint, potentially going to see some profit taking coming in. Okay, and we had the Scottish referendum. We knew that if the Scots voted to leave the Union, then that would throw a lot of uncertainty at the markets with the end of this 300-year Union, 4 times longer than the Union with the European Union. So potentially a lot more destructive in terms of domestic affairs and a lot more bureaucratic, might I add, with the intertwining of Scotland, England, and Wales. So regardless of the potential fallout, we knew that, hey, worst case scenario, if Scotland decided to vote to leave the Union, we have our entry just below the low here, stop loss above the high. And even if they didn't have the Scottish referendum, we'll trade this one as a short or as a sell anyway, because we can see that if our entry is just below the low and our stop loss is just above the high, we've got good profit potential here. Okay, and it's a fast breakout. Okay, so good reward potential here, risking 1%, which is, say, for example, we had our entry just below the low of this pin bar, stop loss above the high, and had all this profit potential. It's a 8.6 to 1. Okay, so that's good profit potential, very good profit potential. So, you know, it's 50-50. If the Scots have voted to leave, then this trade, no doubt, would have really gone in our favor very quickly. Had they voted to remain in the Union, then it's likely the market would have either rallied, the FTSE would have rallied, or have done nothing. Okay, so it happened that they voted to stay in the Union, the Scots, and the FTSE went down anyway. So it's probably not much of a disparity between what the market was expecting. People really, the Scots really not making that very, very, very kind of like a bold move into the unknown, should I say. Okay, so it ultimately went our way. So sometimes news can be positive for the country, but if it is what the market expected, you might not see any change contrary to where the market currently is. Okay, so just bearing in mind, I know we're making very fast progress indeed. So one thing I really want you to take away is we use news as a catalyst to essentially take our winning trade or perpetuate our winning trades and to give us the outcome of our losing trades far faster. If we're already in a position like we are, we're able to piggyback the profits and use these news announcements to accelerate the profits. But if we're the wrong side of the news, then we can essentially use a combination of risk management and our protective stop loss, which our brokers give us in order to get us out of the market at a small loss, risking 1%. Of course, there's absolutely no way to be on the right side of the news all the time. But if we can do it some of the time, and we can have setups or trade setups with high profit potential, then we can make more from news trading than we stand to lose, even if we are only right, say, a third of the time when it comes to being on the right side of the news. All right, so say, for example, we're trading the daily and the weekly. I'd thoroughly recommend these time frames for you because it enables you to really just kind of like take a step back from your trading. Remember, there is a disproportionate relationship between the time spent in front of the screen and the money made from trading. Okay, a lot of people think, and I think this is from how society has preconditioned us into like the more hours you spend behind the desk, the more money we'll make, the more likely we are to be promoted in our day jobs or our careers. In trading, it's kind of the opposite, really. Okay, especially if you're a end of day trader or end of week trader. I always say to my clients, then, you know, how many times do you think you need to look at the charts if you're trading end of day? Well, the answer is once, and you can do that in the evening. Or if you trade the weekly time frame, how many times do you think you need to look at the charts when you're trading the weekly time frame? Well, minimum, I would say once a week, and you can do your analysis at the weekends when the market is kind of asleep, and that's the wonderful thing. You don't get suckered into the flickering lights and the moving bars like a lot of people, especially newbies, are when they see the flashing broker platforms and the news announcements and the kind of hyperbole which a lot of people suffer from, and the desire to always be in it, the fear of missing out. These are huge key obstacles which a lot of people kind of endure when they are new to the markets. They always want to be in it. But I would safely say, from my blood, sweat, and tears, it really doesn't matter how much time you spend in front of the screen. But I would simply say that less is more and more is less when it comes to mastering a strategy and not kind of like forcing it. Take liberation with the fact that, hey, if you've got nothing to trade based on your strategy for that day or that week, just tell yourself, hey, it's a valid trading decision not to take this trade. And that's as valid as if you saw a trade setup which conforms to your strategy and gives you an opportunity to trade. Okay, so don't fall into the trap of missing out. People will always be talking about the trades they're in, especially on online forums or things like that. But ultimately, you can just remind yourself that it's very likely that they'll be trading a different strategy to you. They'll have a different perspective than you, and they sure as hell probably won't be profitable if they're only talking about their winning trades. And that's a real trait a lot of kind of like people have, is they will only talk about their winning trades, never their losing trades. Okay, so we're drawing rapidly towards the end of our webinar. And I would like to basically say thank you for your attention. And I would like to draw your attention to something we're doing a little bit special today, a little bit different, exclusively with Traders Talk Live. And I think you're going to like this. In fact, I know you are. We want to give you an invitation to being part of this, or our global community, with the Lazy Trader. Our courses have been accredited by the CPD. We've got a 100% satisfaction guarantee, and we've got an excellent rating by Trustpilot and Forex Peace Army. We want to give you an invitation to take part in all of the action, where you will be able to learn to trade successfully any asset class in any market from as little as 10 minutes a day, with a specialization on the daily or the weekly time frame, whichever you choose. Okay, and here's just a little preview of what the membership portal looks like online. You can access this on your phone. It's app driven, it's interactive. You've got movies, videos, podcasts, flip books, forums, you've got bonuses. You've even got a Traders University examination, which has been CPD accredited as well, and you'll be able to be scored and get a certificate signed by myself, which will reflect your level of proficiency. So you could get a merit pass, but I would rather hope that you get a distinction. And this has been proven to be really popular, and we've had a lot of success in training students this way ever since we've had this enormous overhaul. A lot of investment has gone in to this online training to make it as fun, as interactive, and not dry in the slightest. Okay, so this has been valued at $1,997, but what we want to do is give you access for $1 to try it out. Okay, you'll see on the website it's $252 as the website special, but we want to give it to you for $1, and this offer ends at midnight tonight. It says Monday, but it's actually tonight. Sorry, bit of a typo there. The ultimate package, like I said, has been valued at $1,997. You can get it for $1, and I'm going to give you these bonuses. Trade Voyager, which essentially is pattern recognition software, which many of our clients use, which helps to preempt patterns and potential entry points into the market, reversal points, and trend following trade signals as well. And we've got our Trader Hypnosis audio course, which has been formulated by Kay Lee, who's one of our mentors. So what I want to really emphasize is you can have this for $1. Please be aware that this has an ongoing subscription of $160 on a monthly basis. You can cancel at any time, and this will give you access to everything. We don't hold anything back. Video tutorials, podcasts, exclusive interviews, all of our strategies, both basic and advanced, weekly market analysis webinars. Everything will be drip fed into your email accounts. You'll have access to our moderated forums. We'll have guest traders presenting. And all you need to do is go to our website, thelazytrader.com/online-trading-course, read the terms and conditions, buy the ultimate program, and use the promo code Traders Talk in lowercase, please. And now hit submit, and that will generate your discount. Okay. And this is just really a fraction of what you get. Okay, remember I mentioned you get that professionally recognized qualification if you come on board and you do our examination, Traders University. And we don't hold anything back. Okay, and we're dedicated to basically making trading into a peaceful and relaxing activity for you. It doesn't have to be stressful or time consuming. Okay, and if you're not satisfied, we'll just give you a refund, no problem. Okay, so if you have any questions, do let me know. Thank you so much for your attention. I always enjoy doing these things, and a big thank you for Tanya for being so patient with me with my technical hiccups. And if you have any questions, feel free to ask me now, or indeed drop me an email. My email address is rob@thelazytrader.com, and I look forward to hearing from you, or indeed working with you